Hi, and welcome to this quick tutorial on two-in-one self-banking concept. And I think you're going to find out how awesome this is. Maybe you haven't heard about it. Maybe you might have heard a couple commercials. You've heard it maybe as bank on yourself, infinite banking, be your own bank, family banking. There's a lot of different names to this, but it all basically does the same thing, and it's been around a long time. So I just want to get this idea across to you so you can take a look at it and see how it might be working in your life here. But I have some goals in mind here. Of course, we're trying to eliminate debt, make it much quicker to get out of the way, right? Obviously, it's the best thing to go is to get rid of debt quicker. How to get 10% or even higher equivalent rate of return each and every year uninterrupted. Okay, that's the goal here. What I can show you how to do it. Access your money for your entire life. No penalty or restrictions. And that's what you're going to find in 401ks and qualified plans, 403bs, whatever. There's some sort of restriction guideline, but there's actually another tax code that this falls under, and that's why the bank loves them. But without having to worry about Wall Street crashes or economic recessions. So this is completely safe. It's guaranteed. There's a lot of things to it that you're going to love. But let me get an idea of who I am. My name is Rick Wagner. I'm with Legacy Builders, and I've been doing this for 18 years. And I've changed the course of my career a little bit to really hone in on something that works great. Because I'm tired of putting people at risk and seeing what people are doing with their money. It's pretty crazy, but I got a big family. I got 4 kids myself. I got 3 stepchildren in the house, and my wife Jessica and I in the middle there, you'll see. And we live right here in the Hastings area, Minnesota, which is a suburb of the Twin Cities. And so life is pretty active. But I love what I do, and I love helping people, and that's my goal. But let me get right into it here. Now, this concept that we're talking about, I want to make sure you understand that we really finance everything we buy, whether it be through interest we paid on a loan we acquire to make a purchase, or the interest we give up when we use the money we have in the bank or somewhere else to make a purchase in lieu of using a loan. So we're financing it no matter what we say. It's either interest paid on a loan or interest we give up. Okay? And compound interest, it works for you or against you. There's no way to be in the middle with that. And because we do that, it's my goal to try to minimize the negative economic impact that this truth has on our lives here. So what this concept, this two-in-one self-banking, you've seen it on Fox News, CNN, USA Today, NPR, Wall Street Journal, New York Times. There's a lot of media that's been on this. Best-selling books, Bank on Yourself, Be Your Own Banker. Of course, Nelson Nash, who just passed away, but he reinvigorated the concept, but it's been out a long time. Patrick Donahoe's book, Heads I Win, Tails You Lose, and of course my book. It's not a bestseller, but it's just getting the word out. But this really creates a home base for your money, okay? And that's what you want. It's kind of like a checking account for your checking account, really. And what's needed, you got to have some sort of income, okay? You can't be living on the curb or anything like that. You have to have a little debt, a lot of debt, or no debt. And you want to see better, faster results in your savings and paying down of debt. Okay, so everyday problems here, not saving enough for retirement. These are some of the things that you could have in your life. 401k not working as good. You got debt, car payments. You want to pay off your mortgage quicker. We're getting older. We got health issues. Want to plan vacations, but it's more difficult. We don't have good emergency funds. So right here, basically money is going out more than it's coming in. And I don't care how much you make, whether it's 6 figures or multiple 6 figures, or if you're just making a regular income of 40, 50,000, whatever, you're usually going to live up to what you make. And so it seems like no matter who I run into, there's always money issues, and uh, you never know what they owe compared to what they make, and if they're saving enough, they're investing, whatever. It's kind of the same for a lot of us. But here's the processing of your money. Say you have $2 million average lifetime income. This is the average. Well, 60,000 of it is the average total assets at age 65. It's pretty pathetic. But here it goes through the funnel. All your money comes in, it's going out with debt, living expenses, taxes. We got workman's comp, state income, inheritance, let's see, insurance, vacation, utilities. We barely are able to save. And really, it's not a 3% savings. It's more like about 1.5% is what the average is. So it's not very good. We need to do better. But there's a way of doing this that you don't have to break the bank. You can really, this whole concept is going to be kind of where you're at now, and not about taking more and hurting your lifestyle even more. But this is the problem here. You got 34%, which is really 34 cents on the dollar. You're paying out to finances, which is interest charges to banks. Okay, that's a big problem. You got taxes going out, whether it be Social Security tax. You got things you pay for. You go out to dinner, there's taxes on it. There's electricity tax, there's gas tax, everything. There's a whole list of them. That's too high as well. So these are the two problems that we need to fix, because it only leaves us with 23 and 3. 23 cents on the dollar to live on. We got 3% to save. Okay, so what I'm going to do is take a holistic approach. This is what other planners don't do. And the reason why I do this is because I don't know why they don't look at everything. So we're talking taxes and interest and other fees, trying to eliminate them or lower them as much as we can. Eliminating loan risk, bringing a realistic and true timeline of where you can retire, so you know what you're going to have. We can actually do that. You know exactly what you're going to have. Safeties and guarantees. I'm not showing something that's risky, but something that's been around in an industry that's been around almost 200 years, really. Okay. What they don't want you to know, as far as a broker and a financial advisor, that the cost of these qualified plans, the taxes, of course, they don't really want to get into it so much. They think taxes are going to lower, whereas I talk to just about everybody. They know taxes are going to go up. Okay, you got broker fees, you got trading fees, administration costs. Okay, I won't go into all this, but there's fees that is really taking apart your plan. Okay, and you're paying taxes on fees and you'll never even see or touch that money. Okay, that's a lost opportunity cost on your money. So we're trying to eliminate this. And what I'm going to show you here is some of the fees, some of the taxes, and show you both sides of the coin. But if we were to look at the S&P 500 over the last 20 years, do you think it'd be 8, 10, 15% annualized return on it? And of course, it's 4.5%. But the S&P 500, that's the top 500 companies in the country. It's what we kind of have a chart on what we're doing in our country. But this is what the chart looks like. It starts over here, goes down a little bit, slowly raises through the years, so we get to about 2000, and then slowly starts to descend to where we're at. And this right here, 4.56, I believe, 4.58. My eyes aren't that great anymore, but this is the average. So this red line might as well be what it's been the last 20 years. It's pretty not so good, right? But if we look at the 20-year rolling returns going back to the 70s, which means every 20-year period, stock market's going back to the start date of around 1950. So we can get a conclusion in this that a vast majority of this long time period, 20-year annualized return was under 8%. It's usually going to be between 4 and 8%. People think they're getting 12, 15%. And that's part of the problem with the brokers, that they think an average return is actual when it's not. And I have a whole illustration that goes on that. But I like to be real with people and tell them this is what's really happening. But let me look at another example here. Family income. If we look at some of the taxes and interest that you're paying, let's say you get $100,000 a year combined income, $30,000 income tax, so we're left with $70,000 after tax. Divide that in 12 months, that's $58.33 a month, which 2046 we're paying in interest charges. Okay, it's example here. Mortgage, 6% interest. This is the amount we owe on it. This is our payment, $2,098. Principal, which is what's used to pay down the actual debt, and then the interest is what we're paying the bank to take out the loan, right? That's 83% interest, which is amazing. We look at a car, credit cards. This is their interest rate, 7.18. This is their payment, $599, $200. And so a lot of it is going towards interest. So this car, 24% interest volume of the whole payment. It's quite amazing. Credit card, 75%. So that's where they got this 2046. As you add up all the interest compared to what we're paying, it's average 34.5. That's pretty close. Okay, this is common, but it's not the annual percentage rate. It's a volume of interest. When I saw this, it kind of was an eye opener because I just paid attention to the APR. You just don't think this way. But if we're paying over $2,000, I mean, of $5,800, you're just treading water. You're going nowhere. So let's try to speed this up. Do you think other financial planners are going to tell you this? No. You got to go to some sort of debt agency or whatever that most people can't stand anyway. But let's look at the typical setup. You got income, it goes into your checking. You got expenses to pay off, and you get what's left over, right? Well, self-banking, we're just adding a little caveat to this. And this just acts as a capture for your cash flow. All right, so money goes this way. We send a little bit to our bank, which we own. I'll show you how this is set up. It's very easy. And we can reciprocate through checking. We can go back and forth. But this is getting your money in motion. That's what we want. We want your money moving instead of stagnating, sitting in some whatever account, earning something, and that's it. We're trying to get this used as much as possible, and that's what the banks do. How do the banks make money? Well, what do they manufacture? They don't manufacture anything, really. They don't produce anything, but this is what they do. A bank customer comes in, gives money to the bank, whether it be checking account or whatever. Well, they're going to loan that money out everywhere, whether it be to businesses, to car loans, credit card, debt consolidation, home mortgage. Okay, and there's different interest rates for different things, right? Based on the risk that they understand that you need. What this is called a fractional banking. So they have $1, you can loan out 10. Whose money do the bank use? They use our money. So come in one side of the bank, you go out, and you have to go to the other side of the bank to get loans on the money that you just put in. So it seems like a scam, doesn't it? But this is the way our banking system is. Now, this is what a self-bank does. Now, this illustration isn't the greatest, but hey, I'm no PowerPoint expert, okay? Trying to do my best, but what we do is fund this bank, and it's an account, all right? It builds up. You can either start with a little, you can start with a lot. It's up to you. But we have credit cards, we got car loans and whatever, debt, mortgages. We got this stuff to pay off, right? So we keep doing it. But now, when we build up our bank, our 2-in-1 Self Bank, as soon as we get enough money, we pay off a debt. Okay? And once we pay that off, okay, we redirect that money towards our Self Bank. This grows. Okay, now we got more things to pay off. And as it's being paid off, now we've paid off the second one, and we're going to apply it towards the third. Our Self Bank is getting bigger. So now once we get enough money in our bank account, or our Self Bank, we can pay off the third one. And that's really the goal here, is just building this account enough to pay off each and every debt. Now we got enough to pay off the department store cards. Get rid of that. Our self-bank is getting bigger. Now we get to a point where we could get to the fourth one and we pay that off. And so all this money that was here, that was going out the door, is now being redirected to our self-bank. And once it's big enough, we can apply it towards our debt. Now we got the mortgage, which usually is last because it's our biggest debt. We can actually eliminate that with our self-bank. There's other things too. There's vacations, college loans, there's boat loans, whatever. You decide on where you want to take a loan on yourself. And it works the same way. Our self-bank is getting bigger. It's getting very big. Okay, it doesn't happen overnight. I'll show you the timeline of this, but first one pays the second. We pay off those. We can get rid of these debts as well, and it's on our own timeline. We don't have Guido or some. You probably don't go to a loan shark, but we don't have collectors coming at you because this is yours. You decide when to pay this off, but it's a good idea to pay it off, of course. And so here's an example here. Year 5, you got 53,000. Year 10, you might have 119, 292. It really grows well, 743. All right. So the whole idea with this self-bank is we are growing money in your account, not we, but the account that we've set up. Only you have access to it. And you can take loans off at any time, and it's growing. And as you take loans off of it, the money keeps growing as if it never left. Now, that's huge because you can't do that anywhere else. This is why the banks do it. You can't do it off any other program, any other feature of any, and I'll show you how this works, but your money will grow continuously, all right, uninterrupted. And you can access it tax-free, which is phenomenal. So in retirement, now you can access it tax-free and to worry about the IRS coming at you or Uncle Sam. So this is what most people do. All right, so this is the timeline, this blue line here. As we kind of gather money up, save it, get a little more, next paycheck, we get to enough to where we could buy something. All right, well, then we pay it off. We go back down to where we started. All right, the second item, pay it off. Okay, you see where this is going. This is what most people do because that's all we kind of know. Unless we want to borrow it, right? So now we go into debt, slowly pay it back, so it's paid off. Go on the second one, into debt, pay it off. All right? That's the only two things people think of, unless you have a rich millionaire grandpa or uncle or something. This is the 2-in-1 self-banking method. All right? This is how the system works. Let's say you have money in your account, you take a loan off yourself, and you slowly pay yourself back. You look at here, it's not straight across, it's going up. That earned interest the whole time, you were paying yourself back. Now you want to get something else and pay it off. Slowly pay yourself back, get to this point, and as you can see, as the timeline goes here, now we look at, we're way up here instead of down here. So our money has been growing the whole time, using it. You're doing two things at once. That's how this works. Okay? This is the timeline. This is kind of a hockey stick feature. All right? It's not get rich quick. It doesn't happen overnight. But as the years go by, it usually takes about 4 or 5 years, we can start doing something. And by the time 20 years kicks in, we have some serious money. It depends how much, of course, you're putting into it. You can start $50 a month. Most of the time, we're finding about $300 on average, $312 a month that we can find to go into a policy. But let me show you what we want to do here is past 4 phases. So if we're going to put our money into something, we got this shoebox as an example. Not very good, right? But this has to have 4 phases to it. It's got to be liquid. You got to have access. It's got to be safe and guaranteed because we're talking about money that this is for your life here. Good rate of return, and we got to have some sort of tax benefit. Got to pass these 4. So we look at all the possibilities here. Art. Who's going to put their money in art? I mean, we got commodities, we got venture capital. This is all speculative. As we go down here, it gets a little bit more safe, okay? But also we're losing interest. We go way down here, T-bills, some money market. Okay, we got traditional life insurance, cash value. So this is a foundation, and as we go up, it's riskier, all right? And we just don't know what to use, right? But it's got to pass 4 phases, right? These 4 phases. Well, when it comes down to it, what's worked throughout history of our country, and it's been the backbone of our country, is this 2-in-1 self-banking. It's been happening for a long, long time. And this is the product that we use. It's a cash value traditional life insurance, believe it or not, but not the kind that you're familiar with. This is a high cash value, mutually owned whole life insurance, all right? I'm not just some regular guy offering insurance. This is a whole different concept that each and every bank uses for the last 150 years. It's designed by us, okay? That's what mutually owned means, the company that is owned by all the shareholders, all the policy owners. You're guaranteed to have access up to 95% of your equity right out of the gate for whatever you want. Nobody's going to ask questions. You do it however you want. Your money grows while you still use it. I already mentioned that. Premiums fixed, guaranteed. Company can't increase them. Okay? Only you can take away this thing. Your gains don't vanish when the market crashes. There's no other type of permanent or cash value insurance that comes with as many guarantees. Now you look at the articles, you tell me, okay, Rick, insurance, really? Come on. Hopefully you didn't click out of this already. But this is different. And so just give me a few minutes here. You look at the business journal articles, and they break into it. You got, retirement plan demystified. They go into it a little bit. So there's a lot of people talking about whether it's good. You go into Google, you see all this stuff here, and you click on it. You ask Motley Fool, what do you know about it? Well, they go into it. You know what they're going to tell you? Oh, we got some more better advisors here. Come get our stuff. Take a look at our newsletter. Apply here, whatever. And they don't understand it. They don't want to understand it because this is cutting them off at the knees. They're not making serious bank. They want you to come in the doors with so they can make a lot of money on what you do. So obviously it's a money motive, right? Who's done this though? Who's done this self-banking concept? Well, like I've told you before, you've seen it on the news. Every bank uses it. I mean every bank. Okay? Most of them have it as their tier 1 capital. A good 40% of what they have is in this. Okay? Congressmen, congresswomen. Walt Disney started with this. Ray Kroc of McDonald's started with this. Pampered Chef. Vanderbilt University. J.C. Penney. We hold seminars, financial education, the workplace seminars, churches. Okay, this is everywhere. But you haven't heard of it because not enough people are making enough money off of it, all right? Well, that's not my whole goal. Obviously, they always say you got a mortgage to pay, right? I'm making a little bit off this. It's not a lot, but it's fair for everybody. In fact, the people I set up with this is making phenomenal amounts. The insurance companies that I work with, they're making a little, but they're not making a killing. They're making way less than what those planners are with qualified funds. But I like, if you remember the movie It's a Wonderful Life, it's one of my actually favorite movie. But this quote here is really good. All you can take with you is that which you've given away. So I'm looking at doing the right thing. That's why I went into this. Okay? But let's look at what a qualified plan like a 401k and what they're telling you. And I won't go into too much detail here because everyone loves charts, right? Says nobody. But let's say you're getting 8% rate of return. You got $3.5 million for retirement. It's pretty good, right? Account grows 3.5 million. Everything's all golden, right? That's what they're projecting. Well, they're missing out a lot on what they're telling you. With the employee match, it puts it about 3.8. That's good. Rate of return 8.36. That's what they're telling you walking out the door, swat you in the butt. Hey, good job. That's what we're going to do. Well, hold on. Okay. Slow your roll a little bit because this is what happens. Management fees added in knocks it down to 6.23% rate of return, knocks it down to 2.38 million. Okay, so 608,000 worth of management fees has also cut the value of your money by over 1 million. The money they earned from managing the account had the potential of earning 1 million. That's a huge loss. Okay? Of course, that money won't be taxed in a lump sum. It'll be taxed as the money is withdrawn. So now, feature number 1, your net account value is what matters. Now it's 1.5 million. That's a lot less. A lot less. Okay, it's a far cry from 3.5 million. Third point here, rate of return dropped by almost 3%, 4.77. These are actual numbers. Okay, it's not some amplified number they're trying to tell you. So the goal here of what I'm talking about is 2-in-1 self-banking. It's insurance in reverse. We're trying to get the least amount of insurance, the highest amount of cash value. We're using the chassis of this thing, and we have what's called paid up addition riders. It's kind of putting your money on steroids, and it gets your money built up 40 times faster than anything a typical plan would have. Okay? A loan is backed by the cash surrender value of your policy, which places you in a much strong financial position to begin with. And it's because of this fact that there's no repayment schedule, no worries if you don't pay. Okay, so what goes down is the death benefit. So if you take a loan off your own money, right, you're really taking a loan off the insurance reserve. Okay, it's not directly into your money, but it's correlated to what you have. But you're taking a loan from the company. So what goes down is death payment. So technically, you don't have to pay it off at all. But you didn't hear me say that. But it's yours. And if a bad circumstance should arrive, you don't have to worry about ruining your credit by going into default and then paying higher finance fees. So 2-in-1, when one takes a policy loan, comes directly from the insurance company. Okay, that's what I mentioned. Cash value inside policy stays put. So again, we did this because it's got to pass 4 phases, and this does it with flying colors. Now let's see the difference. Let's look at some examples here. All right, this is a typical policy designed for maximum death benefits. All of it goes into the base of the policy. You have very little cash value. Okay, the cash value increase. It's slowly going up. All right, but let's look at what's designed for 2-in-1 self-banking. We have base plus what the paid up addition riders I mentioned to you about. So the cash value increases, it's a lot faster. A lot faster. But let's really amp this up and design this the best way we know. And so what we do is have a regular base policy, paid up additions rider. Now we build in a little term with it. Now the reason why we do this, in the 80s, they had to put laws into this. It's TEFRA, and there's some other acronym names, but I won't go into it. But what it means is it's got to pass a 7-pay test, which means you can't just put $1 in and then save $1 million in this thing, right? It's got to have a ratio of insurance. That's why we add term to it, because we can build the ratio higher, so we can build more cash value into it. And so by doing this, now look at the cash value compared to an original policy. I can see why when I first mentioned the word insurance, people run, because that's what they think they're getting. No, we designed this to build up cash value much better. That term drops off. Eventually, you'll still have your whole life policy in place, which will have a huge death benefit, as you can see where the cash values are. The death benefit's even higher. Okay. This is on a typical age 35, good health, so whatever. It doesn't, by the way, you can put this not even on yourself, put it on a spouse, family member, coworker, whatever. So even if people are in bad health, we can get this in place. But remember, we talked about the problem, and the solution is after we do this, now your financing's down, so is your taxes. You get to keep 33%, save 15, that's 48. That almost doubles it. Okay? It's a nice solution, wouldn't you say? Let's look at Mark and Joyce. This is an actual couple here who did this. And what you're going to see, this is their total debts. The remaining debt is $179,000. Their real debt, $374,000. It's pretty big. This is the interest they're going to pay. It's a lot, right? Of that 374, 194 is going towards banks. So let's try to eliminate that. But this is their monthly payment, their interest rate. Okay. And as we go through this here, let's look at how we can fix this in a 2-in-1 banking. This is how it works. They're going to pay off their house in 29 and a half years in the schedule they have now, whereas they do it 2-in-1 self-banking, 7.75, much quicker. It's a huge difference, right? They're also going to have $1.1 million to show for it in their savings, compared to zero, which is the plan they have now. So what we do is we're going to itemize what we should pay off first. Here's their principal. Here's their regular payment they make, but we add what's called a power payment. This is your coming out of your policy. We accelerate this whole Visa payment by doing this. So number of payments going to take is 2 payments. We pay that off. We take this and apply it towards the second one. So it's kind of like snowballing your debt. And this is where, if you want to talk about Dave Ramsey's program, the snowballing, you pay off one, use that money to pay off the second one. It's kind of in that fashion, but an added caveat to this is when we're doing this, your money in your account is still growing. So we're not waiting to get all your debt paid off and then start saving. We've been saving from day one. So it's much more accelerated. And what we're doing here is uninterrupted compounding of your money that doesn't have to wait till you pay things off. That's what I just said, right? Now, what this does, we got 11 out of 12 things that makes almost a perfect place for your money. The only thing it doesn't have, it's not completely tax deductible. We're putting in after-tax dollars. So it also creates contract law, not just tax law. Okay, nobody can change this once you have it in place. You can dump the policy at any time, but they can't. There's no risk. There's guarantees. There's no penalties. You have access to it. It's got creditor protection. You can leverage this money. It's tax deferred, tax-free access. You have collateral. You have disability benefits. That's another thing. I'm talking to somebody I know that doesn't have anything on their husband, and if they actually take this out, let's say you have $100,000 or $200,000 death benefit. With the disability benefit in here, there's a way. If you can't perform 2 of the 6, they call it ADLs, 10 of daily living. So if you can't dress, you can't bathe, you can't feed yourself. Anyway, if you have a stroke or a heart attack, something like that, you're not going to be working. You probably can't function for a little while. This is going to keep you going. So there's a portion there's a percentage, I think it's 25%, but you're going to get 50, 100,000 that's going to carry you for a year or longer. So you don't lose your life, you don't lose your house, you don't lose everything. That's in this. Not only the money you save up can be accessible, but you also can have disability benefits. That's phenomenal. There's nothing out there like that. Anyway, I digress. But again, this is a home base for your money. there's a lot of things that I love about it. And so when somebody goes online and says, I don't know about this, I'm going to check it out, and they call their financial planner, oh, you don't want to do this. What do you, insurance? Are you crazy? No, this is different. And this gets your money working while you're doing stuff in your life. So this goes for your whole life. You don't have to worry about ups and downs of the market. You don't have to worry about how our economy is doing. And you can do things in life and have empowerment over it, and nobody can get at it. So it's huge. That's why this has been going on. All the banks have been doing it, and they don't tell you about it. So how do we find the money? There's a lot of things we could look at. That's why we have 2 sheets you fill out. You put in your pluses, your minuses, what you're saving, what you owe. We just kind of look at it, and we take a look and say, this is what we think you should do, and you tell us what's comfortable. And we'll find a good breaking point of what you want to do. And that way we can give you a get out of debt report. Okay, we can find out how long it's going to take you to get out of debt, what you're going to have in retirement. Exactly. Okay, and that's what I'm here for. So I can work nationwide. There's a lot of people I've been working with across the states, and this plan, once you get with us and start understanding how it works, you can start small or start big. You can get rid of your 401k. You can keep it. There's a lot of ways to do it. You can even just save up to your match that your company's matching and add this to it. All right, so it's whatever you're comfortable with. But we can set you in place with this. And so take a look at 2in1plan.com. And I thank you for listening to this, and I hope to talk to you soon. Thank you.